Welcome to Ilagan Whiteboard Friday, where we look at complex legal and compliance issues in a simple to do way. This series is brought to you by Ilagan, your partner and provider of end-to-end business services.
Hello and welcome to Ilagan Whiteboard Friday, where we look at various tax and compliance related issues in a user-friendly fashion. Today we will look at a very hot topic called FDI, which is foreign direct investments. There are multiple rules governing around FDI, so a lot of big ticket investment, not the very low level angel or a seed fund kind of things, might still be available from the Indian money, but most of the VC or higher level of angel or seed funds are still coming through foreign. So a lot of foreign money keeps coming in. So whenever we talk about investments or raising fund, FDI more or less is inherent into the whole thing. So there are a lot of rules and restrictions that we should be aware of before raising an FDI. Otherwise, it could actually lead to a lot of disaster. RBI is very strict on following the rules properly, and if there is any non-compliance, then the businesses may have to pay heavy penalties. So there are primarily two kinds of channels available on a broader scale. If you look at it, there are two kinds of channel available. One is called a pre-approved route, and the second one is requires permission. So some industries or sectors has been defined to accept up to 100% of FDI or other limits. So the limits are defined by FDI. You should be knowing about those limits before deciding how much money you are trying to raise or how much stake you are diluting. So if it is, if your sector or your industry falls under a pre-approved route, that means you can actually get the money first to the company and then intimate RBI about the foreign direct investment. Please note that intimation is must. The liberty is only given that you can actually decide to take money first and then you can intimate to the RBI. The other one is the other sectors which requires pre-permission. So that means if you are planning to get any FDI into those sectors which falls under pre-permission kind of stuff, then you have to make an application to RBI, or there is another board like Foreign Investment and Promotion Board, where you have to give your complete details of what exactly you are trying to do, how much money you are trying to raise, and what are the other various factors about your details of the project and company. Based on that, the FIPB goes through all the proposal in detail, takes a call whether they would allow it or not. Once they approve it, then based on that approval, you can get that much money into India. Now, this is very important. So any foreigner or any foreign money which comes to India has an ultimate goal of going outside India as well. If you don't follow a proper intimation or taking an approval from RBI, tomorrow when you are trying to repatriate the money, then it is not possible. It would become very, very challenging. RBI is very strict, so don't take any chances. You should know what it is. If you don't, then better take the help of an expert who can actually advise you during the whole process. So these are the primary two routes. One is a pre-approved route and another one requires permission. Then in either of the scenario, valuation of FDI is very important. So RBI wants to know on what grounds, say if you are saying I am diluting say 10% or 20% of stake for $1 million or $10 million. So what is the basis of valuation? So valuation of FDI is very important. Based on this, like whenever there is an exit or exit of the FDI, so this also comes important for the capital calculation of capital gains taxes. So valuation of FDI is important. A chartered accountant is the right person who can help you arrive at a valuation and even certify that. Then I've already said you need to meet various RBI guidelines. So there are various forms defined for doing various activities. For example, if the company is getting a money, or even a shareholder, like you have formed a company and then you can sell your stake also to an NRI or a FDI. So even NRIs actually come under FDI. So if you are selling your stakes to an NRI or a foreign individual or a company, there are different set of process or guidelines to be followed. There are time frames which is defined by RBI. Even in pre-approved route, for example, you can get money, but within a month you have to intimate to RBI that similar money has come, and then within certain deadlines, about 6 months or so, you need to issue shares or you have to sell the shares and again intimate back to RBI that the shares has been issued or allotted. So there are time frames almost applicable with each route, each sector, depending on case to case. So those time frames has to be met. And then you have to be very much particular about the restrictions. Say, for example, aviation sector, it does not have 100% FDI. It could have either 26, 49%. A software services company or a product company generally have 100% pre-approved permission. So if you are doing a software company, it is safe to issue up to 100% of the equity as well to FDI. So, but again, check about those restrictions, the limits before taking an FDI. And once you get the money, or if you require a prior permission, go for that. So and follow all the rules and intimate RBI or take approval of RBI appropriately. Otherwise, this could actually be very, very troublesome. Tomorrow you will not be able to repatriate any of this money, and all the money would be stuck in India. That's one issue. There could be heavy interest and penalties, and even other penalties as specified by RBI. That's it on FDI. Feel free to send us an email for any queries that you may have. Our email ID is support@ilagan.com. You can also check out our knowledge base at ilagan.com/KB. Thank you.